the value lows and the value highs, and that just causes me to re-anchor. So I bring the price lows to the price lows. You see what happens? So I've now got the price lows roughly where the price lows are there, yes? And I've now got the price highs where the price highs are here. I've re-anchored my price. And because I've re-anchored my price, this blue line is now relative value against where the price is, right? So obviously during that rally there, the value got squeezed into an area, but it's still bullish. Still bullish. So I don't want to get too caught up in this as a sell trade, that's for sure. I definitely don't want to be in a sell trade. But I don't really want to be in a buy trade in the short term, because if I re-anchored the short term, this obviously exposed itself to a bit of selling pressure in here, didn't it? So there'd be a little quarter of your size. Take a little, you know, if you're a 5-lot trader, take 1 or 2 contracts off in there just to book some cash because of the short-term value divergence. But the macro is still very much on your side, and therefore I don't want to just end up with nothing on the position if the market breaks north. Make sense? Sell-side bonds doing okay, guys. Still doing okay. Congratulations if you're still playing, if you're still involved, if you're still diddling about with this trade. I like it. I like it. I like it a lot. Well done, laddies. 153.26s, 152.20s, $1,200 odd, guys. Pretty good trade. Pretty good. Well, David, it just comes back to that, doesn't it? It just comes back to having confidence, but it's that taking away the fear that your whole entire career is based on one trade that you take. I mean, if you're doing trading properly, if you're involved in trading properly, you're going to be doing thousands of trades in your trading career, right? Thousands. Your trading career is not going to be defined by one trade. It's not going to be defined by one single trade, guys. And because it's not going to be defined by one single trade, why do you put so much attention on what one trade makes? One trade for a loss of 1 tick instead of a profit of 10 ticks. What the hell does it matter in the grand scheme of things? It makes no difference. Your trading career will be defined by thousands of trades. And the big career will be defined by the fact that you've been in all the big trades when the big trades have kicked off, because the majority of trades aren't big trades. There's only going to be 1 or 2 big trades a day, guys. So seriously, there is literally going to be 1 or 2 big trades a day. So when you look at bonds, for example, from 12:30, we've had 2 good trades, 2 big trades, but they're in between that. So since 12 o'clock, we've had this big buy trade here, and we've had this big sell trade, right? 2 trades. But inside that, there's loads of small wee trades. This trade here, this trade there, that little trade there. There's lots of small little trades that maybe do 5s or 1s or scratches or -1s or -2s and scratches. There's lots of wee stuff in the middle. And what you've got to try and do is make sure you get the big stuff. And the only way you get the big stuff, the only way you get the big stuff, is if you don't let the little stuff get to you, right? If you don't let the little scratches, the little +1s, the little 5-tick stops, the little, you get 5 ticks in a trade and you say, damn it, I should have taken 5 ticks. I've gone and got stopped out at +1. Nobody cares. Nobody cares. Nobody should ever care. Because that's just a small trade anyway. Just try it again. Just do it again. Just get back in the saddle and try it again, guys. It's crazy the amount of importance people put on these daft trades. Crazy. So you just put less importance on any one trade, guys. It doesn't mean anything. It doesn't define you as a trader. It doesn't mean anything. Just keep dealing, guys. Just keep dealing. Anyway, we got our target price on the S&P. I was right to wait, correct? Do you see what happened? We were correct to wait. We got our target price. And therefore, this was never going to frighten me off. It was never going to worry me. And sure enough, we went up. Now, what happens if I get stopped out at +1? Well, what happens is I'd get stopped out at +1, right? And what? Who cares? You may say, but you would have given back something like 5 points. Yeah, and what? Tell me, and what? Nothing, right? Nothing. So obviously this is dead obvious, dead easy, dead simple narrative involvement. And this is a macro buy for me. So I'm not going to be taking silly daft trades. I want to try and lean against this. I want to try and let this rip unless I have absolute evidence to get into that short play. Then I want to try and let this rip as much as I can, guys. And if I get stopped at +1 trying, I only need to find 1 in every 2 trades to get a big runner, right? And if every other trade is a stop at break even, I'm in good shape, guys. I'm in great shape. Thank you very much. 1400 hours, always a volatility expansion trade. Did anybody get the first rejection trade at 89.20s? What's the first rejection trade? Right, let's deal with that question. When price moves from an open, it can be for an awful lot of different reasons. When price moves from an open, it can be for a lot of different reasons, profit taking, algorithms, and all sorts of things. So if we get an opening price here, and literally in the first second this happens, this can happen for a whole stack of reasons. But the first rejection we're talking about is when the price rejects that opening drive and goes back through the open. That is what we call the first rejection. Okay, this is what we call the first rejection right there. And the first rejection creates what's called a level 2 buyer. Okay, the first rejection is what's called a level 2 buyer, which is part of that normal structure that we've talked about many times in the past. This becomes a level 2 buyer. Now, why is this level 2 buyer important? Why is this level 2 buyer important, guys? More than any other level 2 buyer in most places. Why is this level 2 buyer important? There's one major reason why this level 2 buyer is very important. Remember that this is the cash open. So the reason why this level 2 buyer is important is because this level 2 buyer is going to have a hell of a lot of volume, right? It's a cash open, guys. So there's going to be a lot of volume on that level 2 rejection. And what happens if it doesn't reject? It doesn't reject, that's what happens. Nothing happens, right? It doesn't reject, that's all that happens. Nothing, right? So either you get the buy trade or you get nothing on that type of rejection. So when the first rejection comes in, and you're sitting watching your oil at that stage, you see the first rejection coming in just there, the price pins to the bottom edge, goes back above the open, and you say, right, there's my first rejection. That becomes a level 2 buyer just there. That's your level 2 buyer there. You've just bought 89.20s, you've just traded 90. You've just made $800 on the first rejection, aren't you? You see that? Now, one of the things that we like to see on that first rejection is a bullish crack spread. Prior to the open, right? Prior to the open, a bullish crack spread. Well, prior to the open, we had this small bullish crack spread, right? We had the small bullish crack spread. So that was at least enough evidence that the first rejection was going to be a buy trade right there. Okay, because even on that big red candle, we never went bearish on the crack spread. The crack spread stayed bullish at that stage. So the first rejection was a bullish crack spread. So we're obviously going to be looking at that and saying, no, I've got that little idea there. I can see it. You might be saying, but it was just as bearish as it was bullish. Yeah, but the price went down. So that takes away the upside move because the price went down, right? It supports the buy at lower prices. It would also have supported a sell at higher prices, but it never gave you a higher price. You get it? So you've got to deal with what you get, and that means that you had your first rejection right there, and that drives the price up to the 90s in a very, very nice $800 first rejection trade. And obviously what we're getting in terms of the bond, the oil drive, is we're getting a crack spread that isn't moving, which is called a parallel shift. If the crack spread doesn't move, this doesn't become bearish because the price is getting driven by price. The oil price is being driven by oil prices, not by RBOB prices, because RBOB is just doing exactly the same as oil. because the crack spread isn't moving. That means oil and RBOB are agreeing with each other. That is not a sell when they agree, guys. It is never going to be a sell when they agree. It's called a parallel shift on the curve. This is bullish. But obviously, coming into something like $90, no questions, always take profits. Always make sure you book some profits into that type of area, guys. Don't close out your position until you start seeing some value to close out your position, and do so. All good?